Welcome to StockTok's deep dive into China Merchants Bank Co. Limited. This is one of mainland China's largest commercial banks, competing directly with the Big Four state-owned lenders by offering retail banking, corporate lending, wealth management, and investment services across a sprawling domestic network. China Merchants Bank operates in a market where deposit gathering and credit risk management determine profitability, and where regulatory capital requirements constrain growth. As of May 11th, the stock is trading at $30.18, sitting roughly in the middle of its 52-week range, which spans from $28.47 on the low end to $37.15 on the high. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. China Merchants Bank generates the vast majority of its revenue from net interest income, that is, the spread between what it pays depositors and what it charges borrowers. The bank also earns fees from wealth management, investment banking, and payment processing services. The competitive moat here is primarily network scale and switching costs. Large corporations and wealthy individuals tend to consolidate their banking relationships with one or two trusted institutions, rather than shop around constantly. Capital adequacy rules set by the People's Bank of China also create a barrier to entry, since new competitors must build enormous balance sheets before they can compete meaningfully. Our StockTok score for China Merchants Bank is 37 out of 100, signaling caution. That score reflects a valuation that looks cheap on paper, 17 out of 20, but profitability and growth that are both significantly weaker, at 10 and 1 respectively. Financial health scores 9 out of 20, and smart money ownership scores 0 out of 20, suggesting institutional investors are largely absent. Now, valuation. The question every investor has to answer: are you paying the right price? China Merchants Bank trades at a price-to-earnings multiple of 7.42 times trailing 12 months earnings and a forward price-to-earnings ratio of 6.88 times. That is below the historical average for large-cap Asian banks, which typically trade in the 10 to 14 times range. The PEG ratio, which divides the PE multiple by earnings growth, sits at 0.58. A PEG below 1 is traditionally thought to signal that a stock is undervalued relative to its growth rate. But in this case, that appearance of cheapness reflects the fact that earnings growth itself is extremely weak. Our DCF model, which projects future cash flows and discounts them to present value, suggests the stock is trading at a 56.66% discount to intrinsic value. That is a meaningful margin of safety, assuming the underlying cash flow assumptions hold. However, we must flag the latest earnings results as context. The most recent quarter showed actual revenue of $86.94 billion against an estimate of $298.810 billion. That is a substantial miss, suggesting either the consensus estimate was wildly optimistic or there are reporting or seasonal factors at play. Net income for that quarter was $37.85 billion, and revenue expanded at 7.8% year-over-year. The next earnings date is scheduled for April 28, 2026, a near-term catalyst to watch. Taking both our DCF signal and the recent earnings miss together, a reasonable fair value range in our view sits between approximately $45 and $55 per share, representing upside of roughly 50 to 80% from current levels, but with the caveat that this assumes the latest quarter's miss was an anomaly rather than a signal of deteriorating fundamentals. Market sentiment around China Merchants Bank leans bearish at present, with broader economic uncertainty tempering investor enthusiasm for the name despite its apparent valuation discount. Moving to financial strength, how solid is the foundation? We begin with the Piotroski F-score, a 9-point checklist that evaluates profitability, leverage, liquidity, and earnings quality. China Merchants Bank scores 5 out of 9, which is below the healthy threshold of 8. The Altman Z score, a model designed to predict bankruptcy risk, comes in at 0.00, which registers as distressed territory on the traditional scale. Do not panic immediately. The Altman model was built primarily for manufacturing firms, and its application to highly leveraged financial institutions like banks requires significant reinterpretation. Banks are supposed to carry high leverage ratios by design because they borrow customer deposits and lend them out. The raw model often misclassifies healthy banks as distressed simply because of this capital structure. That said, it is a yellow flag worth investigating. On the positive side, the cash-to-debt ratio stands at 3.12 times, meaning the bank holds $3.12 of liquid assets for every dollar of debt obligations, a very healthy cushion. Interest coverage cannot be meaningfully calculated for this bank given the nature of banking income, but we can examine debt to equity, which comes in at 0.34. That is extremely conservative leverage. The current ratio, which measures short-term liquidity, shows 0.00, another artifact of bank accounting, where short-term funding is managed through deposit flows and wholesale funding markets rather than traditional current assets. In our view, the balance sheet appears stable by banking standards, though the weak Piotroski score and distressed Altman reading suggest caution. The bank has adequate capital to absorb stress, but operational momentum appears to have slowed. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, or return on invested capital, which measures how much profit the company generates for every dollar deployed. China Merchants Bank's return on invested capital comes in at 0.00, reflecting the fact that return calculations for banks are distorted by the nature of financial leverage. Deposits are not considered capital in the traditional sense, even though they fund lending. A more meaningful measure for banks is return on equity, which we look at in a moment. Gross margin and operating margin both read 0.00, again because these metrics are not relevant to banking business models, where the entire income statement is structured differently than manufacturing or software firms. The net profit margin, net income divided by revenue, stands at 45.19%. That is an extraordinarily healthy figure, suggesting that every dollar of revenue translates into nearly 46 cents of profit. For context, most major banks globally operate with net margins in the 12 to 18% range, so 45% is genuinely exceptional. However, this exceptional margin must be read against the recent quarter's earnings miss, which suggests either the margin is unsustainable or that revenue recognition or seasonal factors create volatility. Free cash flow margin, a measure of cash generation relative to sales, comes in at 136.18%, which again reflects accounting quirks of financial institutions and should not be overinterpreted. The more relevant return metric for banks is return on assets, which shows 1.17%, and return on equity, which shows 11.85%. That 11.85% return on equity is solid for a mature bank in a competitive market, though it trails the 15 to 20% ROEs we see at the most efficiently run global banking franchises. In sum, the bank is profitable and generating cash, but the profitability picture is clouded by the recent earnings surprise. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years came in at -1%, meaning the bank's top line actually contracted slightly over that period. Over the past 5 years, revenue growth stands at 1.8%, a much more modest expansion than one would expect from a large bank operating in a growing economy. These numbers are deeply concerning for a financial institution, as they suggest the bank is losing market share, facing fierce competitive pressure, or operating in a segment of the market that is saturating. The most recent quarter, as we noted earlier, showed 7.8% year-over-year revenue growth, which at first glance appears stronger. However, that positive growth must be reconciled with the earnings miss. Either the growth came from low-margin business lines, or there were one-time factors inflating the comparison. Book value per share, the equity capital divided by shares outstanding, grew at 10.7% over the trailing 3 years, which is a healthy pace of capital accumulation. That book value growth, however, does not translate into profitability growth, suggesting the bank is adding assets but not deploying them as effectively as in the past. The dividend yield stands at 6.98%, a very attractive current income, and a signal that management believes the company can sustain its capital base while returning cash to shareholders. However, dividend yields this high can be a double-edged sword. They may reflect either a prudent capital return policy or a lack of attractive deployment opportunities for retained earnings. In our view, the growth profile is the weakest link in the investment case. The bank is not expanding meaningfully, and revenue growth is either stalled or shrinking depending on the measurement horizon. Now let's talk smart money, what institutional capital is actually doing with this name. The data here is remarkably stark. 0 of the world's top-tier investment gurus currently hold China Merchants Bank in their portfolios according to Dataroma, a tracking service that monitors legendary investors' holdings. 0% of 13F institutional filers are net buyers, meaning that among the universe of hedge funds and asset managers that file public holdings, not a single one is net accumulating the stock in a bullish posture. For context, when institutional ownership is above 50% net bullish, that typically signals that big money sees value and is adding. At 0%, big money is entirely absent or net selling. Insider ownership stands at 0.00%, which is striking. Management owns essentially none of their own company. When management ownership is near zero, there is a misalignment of incentives. A manager making multi-million-dollar salary but owning 0 shares has no personal financial stake in the company's long-term success, reducing the credibility of their strategic guidance. Over the past 3 months, there have been 0 insider buys and 0 insider sells. That complete absence of insider activity suggests either that insiders are restricted from trading due to lockup periods or blackout windows, or that management simply does not believe the stock warrants accumulation at current levels. In traditional value investing, where smart money congregates, that silence is deafening. The absence of legendary investors like Warren Buffett, Charlie Munger, or other top decile allocators from the cap table, combined with 0 institutional net buying and 0 insider accumulation, paints a picture of a company that institutional capital has rejected or abandoned. This is perhaps the most concerning signal in the entire analysis. And finally, the verdict. Let's bring it all together. On valuation, the stock appears deeply discounted by traditional metrics, with a 56% margin of safety suggested by DCF and a price-to-earnings multiple of 7.42 that trades below historical norms. However, this cheapness may reflect genuine deterioration in earnings power, not an opportunity. On financial strength, the balance sheet is adequate but showing stress signals via the Piotroski score and recent operational headwinds. On profitability, the bank generates healthy net margins and return on equity, but the latest earnings miss raises questions about sustainability and the quality of those margins. On growth, the business is essentially flat to contracting over multi-year horizons, with revenue growth of -1% over 3 years, an existential problem for a bank that should be benefiting from economic expansion. On smart money, the complete absence of legendary investors, 0% institutional net buying, and 0 insider accumulation is a powerful negative signal that big money has voted with its feet. In our view, a fair value range for China Merchants Bank sits between $45 and $55 per share, representing upside of roughly 50 to 80% from current levels. But this assumes the recent earnings miss was temporary and that the bank can re-accelerate growth. If that miss proves to be the beginning of a deterioration trend, the intrinsic value calculation falls apart and the margin of safety evaporates. The latest earnings results, showing revenue that came in roughly 70% below consensus, are deeply concerning and warrant waiting for management's explanation and forward guidance before committing capital. Our thesis is that China Merchants Bank is a mature bank operating in a saturated market with limited growth avenues and increasingly fierce competition from fintech and smaller regional competitors. The valuation discount may reflect this reality perfectly, meaning there is no margin of safety at all, despite what the raw multiples suggest. We would want to see credible evidence of revenue reacceleration and margin stabilization before viewing the stock as a compelling value. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on China Merchants Bank Co. Limited. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.